Hello, it's Brian Akers. I want to welcome you to our summer 2022 market review and market outlook. In a down market, it's not fun to put a video or a webinar together about losses in the market. What we're going to try to do today with our speakers, Alex Monk, Bernie McVey, and Mark DiOrio, is explain our thoughts behind some things, explain what's going on in the market, and then at the end, Mark DiOrio will cover some charts about where we are now and where things might be going. Akers Financial Group, we believe in financial planning. That leads us to proper decisions for our clients. So as our client or as a prospective client, hopefully you're understanding that the plan drives the portfolio allocation, which then drives how much of what pieces we add in. We do build our portfolios around protected assets and at-risk assets, and that really helps to preserve wealth as markets come down. So people are pleasantly surprised when they see the market down, but their returns are a lot less down as compared to the market itself. So at Akers Financial Group, we have a lot going on with our expo coming up at August 26th on Friday, August 26th at Water's Edge. You can go to our website at akersfinancial.com and find out more information about that. And we're also sending some information through our email and some through the mail. The radio show, Winning in Retirement, you can see our fancy rooms. We have our logo board. The Winning in Retirement radio shows on Saturday mornings, 11 to 12. That is actually recorded here at Akers Financial Group, Farstow. We take our recording and we put that information on our website under the radio tab. Also, it's through Spotify as a podcast. You can follow it through there, Winning in Retirement, listen to it anytime you like. There, we're giving you our weekly talks about what's going on, then planning and tax, insurance, wills. There's a lot of information there if you're seeking more and more information about what's going on right now and what you'd like to find out how to apply to you. The best way is to have a talk with your financial advisor. You give us a call and set up that meeting for your review to go over where you are right now. And we'd love to sit down and talk with you anytime you like. All right, so this talk's gonna start expanding. We're gonna bring Alex Monk up next here on our market update. Well, I want to introduce to you Alex Monk. Many of you know him as Alexander J. Monk. He has a very exciting summer, looking forward to his first child. Congratulations on that, Alex. And we also want to have a few minutes with you to talk about the AFG portfolios and the investment committee and how we work here at Akers Financial Group. So how are you doing there, Alex?
I'm good, Brian. It's always good to see you.
Yeah, it's fun doing Zoom because not in the same room, but it's almost like we're together. So tell us a little bit about AFG portfolios.
All right, so our AFG portfolios have 4 different strategies. They go from our income model, which is our lower end of the risk spectrum, usually for older people needing more income. Then we have a moderate model, and it is kind of what it says, moderate. And then we have moderately aggressive, which is the more aggressive end. And then as an addition portion, we have what's called the diversifier, which is not your traditional assets. It's more of things that are outside of your normal portfolio construction.
Right. So those models are used as 3 of them are used as core portfolios in our design for clients, where we put a percentage in them, and then we diversify into other satellites to build our portfolios. And we hold these at TD Ameritrade, who's our custodian for our third-party money management. At Akers Financial Group, we have an investment committee, which Alex leads that, and we meet every Monday about the portfolios, about the markets, about what's going on, and about design and what's inside the portfolios. So Alex, I thought we'd start with talking about the first 6 months of the year. I know we're doing our webinar to talk about what's happened and a little bit about what's going to come, but tell them about where we are would be a great thing.
So this is kind of probably the worst 6 months we've seen to start a year historically, in my lifetime, probably yours as well. That's kind of not fun to go through. But what you mentioned before, Brian, is how we use our portfolios as cores. So we're going to have things in there like gold, commodities, things that are going to do okay during these times, and really keeping your allocation to stocks as it balances for your overall portfolio, I think is very important, especially in these volatile times, because we want to own stocks. We don't know when the market's going to recover. Usually when it feels like it can't get any worse is typically when it starts to get better. And I think, we're kind of coming up to that point here soon where how bad could it get?
Well, that's a good and bad way of asking a question. I mean, because if you think back over the years, 08, 09, it got pretty bad. The S&P was down 68% from the high.
Yeah.
Now, here is sort of like a regular business cycle, it seems. And that business cycle slows down and rotates. What happens is we had a really great year last year with the portfolios, and we have our moderate aggressive and moderate are our main stock core portfolios that we design. And those had great years. And this year we've given back a lot of the gain we had from 2021.
It's funny if you look back at it, Brian, and you go to where the markets were before COVID, we're up overall in the markets since that time period.
Sure.
And it's been such a strange time period that looking back on it, most people will say, well, that doesn't make sense that the market was so good. We couldn't even leave our house. So
Right.
it's just like you said, the changing of cycles. There's some monetary policy things happening, but a lot of this is normal function and then a somewhat healthy function for the market because things change, business cycles change, and we're also dealing with supply chain and inflation. So we got to process that as the capital markets have to process what's going on and then decide which way to go from there.
The design of even our moderate aggressive is less risk than the market itself. Is that fair to say?
Yeah. So we're down like about 18, 19 when the market's down about 25 to 30, depending on what index you're looking at.
And that was as of June 30th, 2022. What happens in portfolio design is we have a stock market portion. That stock market portion is supposed to help us over time keep up and beat inflation because we need to have real return over time. So what happens with portfolio design is that when the markets have pullbacks, they come back, they come down. The idea of design was to come down, but not as far down as the market itself. The market comes down more, we come down less. And then that helps us on the recovery side, recover to the positive quicker than the market will itself.
And it's also, to be honest, Brian, it's a big mental thing too. So the less you go down, the less stress you have when you open your statements. And
yeah, I guess one of the problems with the way we do things is that we have stock portfolios and stock statements come every month. So you see the good and you see the bad. The protected portion of the portfolios, they come once a year. And then in their individual reviews with our clients, you can actually see it all together and see, well, okay, the market's down 25, and we're down 8 to 10, depending on the portion we have in stocks. Right. And then that's an overall approach when you add protected in. That's a nice thing. The AFG Select portfolios are something we designed over 4.5 years ago. We implemented. And what's happened over those years, we built this as our core. During the first 6 months, we did reallocate. What did we do on the reallocation, Alex?
So that was just an overall rebalance. There was a lot of funds that had big capital gain distributions or just other types of distributions at the year ends. Mm-hmm. So we wanted to wait until we were at a place where we thought, okay, this is a good time to enter the market with some cash that's already there. And it also takes advantage of any rebalancing, meaning if one fund is way lower than one of its peers or where it's supposed to be allocated, we're technically adding more to that on the downside.
Sure. All right. So we were talking about the past and the way it's designed and what the trade we did. What's your outlook for the rest of the year? Just simplistically, I guess. You don't have a crystal ball or anything, but what do you think?
Well, I said in the beginning of the year, I think, or maybe the end of last year, I still think this is going to be a positive year by like 3 or 4%.
Yeah.
So I have to stick with my my prediction until I'm completely wrong. But the easiest way to have a good run up is to have a good run down. So I think we can hopefully the market will turn around for this year.
Yeah, I was thinking with interest rates probably going up a few more times this year and some other things. So when I predicted my year, I thought we'd be down for the year. And that down is still a number where in June, we actually went down to that number. So between June and the end of the year, we could actually be a little bit up and hit my number. I don't want to be right on a down year, but we've had a really bad start, which leads to a down year overall. But January was a very high piece. Is it fair to say that 21, at the end of 21, there was probably a real bubble in the market, like tech-wise and at-risk stocks and things that are extremely at risk? What do you think?
I think it was almost before that, kind of like middle of last year, some of those tech names started to bust, and
Sure.
they were definitely a bubble. I mean, they were not being priced on earnings or anything like that. A lot of them made $0 or even lost
Yeah.
money, but they're selling at 100 times, whatever.
Mhm.
And then I think some of that combined with greed, that people were making so much money, risk disappears when you're making a lot of money.
Yeah. Risk disappears until they all jump out at the same time.
Right.
And that's sort of, and what's happened is some tech funds are down 50 to 80% from their all-time highs. Now, as clients come in and review, many of them remember the statement when they hit their all-time high, and now it's down some. So I try to give the long-term approach of where have we been over the last couple of years, and we're on that general trend up still, but we're in a business cycle that's going to take some time to begin to grow at a rate we like to see again.
Yeah. And I mean, the
That could be
long-term
right.
market averages are usually what, 6 to 8%.
Mhm.
If you're doing 10s, 15s, 20s, there's only one way to get to that average.
Absolutely, and taking a big pullback is a normal thing that happens in a recessionary slowdown or what we've been going through as they raise interest rates. So our portfolios at AFG Select, we are watching those for our clients, and we are making trades when we need to and reallocating. As the fall occurs, we're going to be examining and looking and reviewing like we've always done, right?
Yep. Hopefully there's some disruption in the market that we can take advantage of. It should be a fun second half of the year, though.
Absolutely. So what happens is that anybody watching our video or has any questions about our portfolios, you can sit and talk with your advisor, or you can call and talk to Alex Monk if you'd like to find out more about what Akers Financial does with our AFG Select portfolios. Thanks, Alex, for your time today. We'll talk to you soon. All right, for this segment, we welcome Bernie McVey. How you doing there, Bernie?
Hey, Brian, I'm doing well. How are you?
That's good. Good. Glad to have you here today to be able to talk to our clients and all those that are listening to our webinar. Our webinar today is about the market in review and the market outlook. So I thought I'd just do a couple of simple questions. Start out with the Bernie McVey thoughts on the first half of 2022.
Well, obviously, we're in a major transition. The results in the market haven't been good. The general economy is in a bit of decline, and some of it is to be expected. I mean, we're coming out of a multi-year, long-run bull market, and it's an environment that was supported by low interest rates and the Fed. Kind of put, if you will, meaning the Fed's going to backstop the markets a little bit. And we're seeing a lot of change to that. Some of it has been brought on by the pandemic, where that pretty much impacted everything. The amount of money in the system, the amount of goods being produced, and so on. And now we're transitioning into a period of restraint. The Fed is not telegraphing it's going to continue its easy money policy. Interest rates are on the rise, which have affected both stocks and bonds negatively here in the first half of the year, pretty significantly. And on top of all that, we've got an inflationary environment. And it's been brought on, in my opinion, by not just the money printing and the amount of money that's sloshing around in the system, but also by these shortages that have been brought on by a whole myriad of factors. And it hasn't boded well for the market in the first half.
Yeah, absolutely. So with the markets down across the board and all different categories seeing downturns, and many of them in the double digit or higher from the markets. The only positive things I've seen this year are some of the dividend stocks. They were holding up very well until June, and June pulled all the ships down at that time. But generally, broad diversification has been a good way to have lower risk than the market. And that's what we do with our core portfolios at AFG Select. What I wanted to do, Bernie, is sort of lead you into talking about from here in at the June 30th being over and here in July, what we see for the rest of the year for 2022. What your thoughts are about that?
Well, I see the inflation continuing. You know, the Fed is saying they're committed to fighting it via higher interest rates. So we can expect, I think at least in the short term, for interest rates to continue to rise. My question is, so how far into the future can that continue? Because there are limits to what the environment can take. And by the environment, I mean stocks and bonds both react negatively to rises in interest rates. So I would expect toward the end of the year that tends to level off, because I don't think the Fed is willing to, shock the environment beyond what's anticipated here, say through September.
Sure.
That's my version of the crystal ball. I think it's going to be a tough environment in the short term, but I'm definitely optimistic long term. I think for investors, you've got to kind of become a little more defensive because of the environment that we're in. I think we'll all get plenty of better feelings around the environment when we start to see it improving. But in the short term, some of the shortages and the inflationary pressures we're facing are going to be with us for a while. Some of them are actually the result of the war in Ukraine and policy at home and so on and so forth. I do expect that to ease off toward the end of the year, is my expectation.
Yeah, when I hear what you're saying and I think about the emotions of market coming down, some people, the first reaction they have is to sell and get out because they believe that the downward trend is going to continue a lot further down. I think what you're saying is there is room for down still in this year. And that room for down would be something where, for longer term investors, it's good to hold through environments like this and possibly invest in this. Is that what you're trying to say?
Yeah, that's what I believe. And we're not going to get warning when sentiment begins to change. And typically when things turn around, they turn around rather quickly. And
Right.
So if you are a long-term investor, to some extent, you want to try to kind of hold through kind of these declines. If you're well diversified and you're in multiple asset classes, you're better prepared to kind of weather, what we've seen here in the first half, because not everything is a tech stock. The tech stock that's declined, 40 to 50% from its highs back in November. Some of the more defensive, high quality dividend plays, for example, are down also, but down significantly less. So, positioning in a more defensive, quality oriented kind of way makes a lot of sense, touching all the asset classes, obviously.
Sure, and that's what we try to do in our core portfolios through the AFG Select and some other third-party managers that we use. Now, interest rates are rising based on the Fed. How's that going to affect the next 6 months in the economy?
Well, I'm expecting interest rates to rise, not for the entire 6 months, but for some portion of the remainder of the year.
Sure.
Obviously, that'll have a short-term negative impact. Some of that is already priced in because the folks that are, monitoring the market very closely are of the belief, almost a unified belief, that that's going to happen in the July and September meetings. the Fed will actually move to increase rates. So some of that is priced in. I do think we have a short term. I'm not sure we've hit the bottom yet. I expect that will be sometime in the second half of the year before we start to see some recovery in the asset classes that have been, hit the hardest. So that's kind of my expectation.
What's your, like, as a final question is, what's your thoughts on market timing versus allocation, where you put your portion in stocks, you try to hold through swings like this?
Yeah, so there is no body on the planet that can be a perfect market timer.
Yeah.
I mean, you can get lucky,
Yeah.
and more often you can miss with that. And so when you consider the investor, you have to consider their time frame. Are they a long-term investor? Are they very concerned in the short term? If you're very concerned about the short term, I'm not sure you should be in the market knee deep. And so your portfolio construction needs to consider that short-term nature of your outlook. But if you're a medium to long-term investor, I think you want to be diversified. It's okay to become a little more defensive when market conditions change.
Mhm.
That doesn't mean, selling everything out and basically abandoning the plan,
Right.
because we're seeing a reduction in prices in the short term.
Yeah, that's good information, Bernie. I know you are a very thoughtful person on our investment committee and really truly help us build and design our models. You actually know a lot about each of the ETFs and funds that we pick with the different managers. And so we appreciate your expertise, as you have added a lot of value for our clients through our investment committee. So thanks again, Bernie, for being with us today. I appreciate it.
Thank you, Brian. It's good talking with you.
Hey, Mark DiOrio.
Hi,
How are you
Brian.
doing?
I'm great. How are you?
All right, we're welcoming Mark DiOrio to our webinar today. Mark DiOrio is from Brookstone Capital Management. He's the CFO. Is that the way you say it, Mark?
The CIO, the Chief Investment
CIO,
Officer.
yeah.
And
Okay.
I'm a CFA, a Chartered Financial Analyst.
So just to confuse me, you got CFA and CIO.
That's right.
Brookstone Capital Management out of Chicago, generally, Illinois. And
Correct.
through Brookstone, you help manage money. You do the day-to-day management of money for our clients. You help implement our AFG Select portfolios. And there's other third-party managers that you guys bring all together. And we really want to have you on our talk today to be able to cover what's been going on in the market and what your outlook would be for the third quarter. So Mark, you've been doing this for a few years?
Over 20 years now. So
Nice.
you start off generally in this field when you're managing money as an analyst. You do a lot of research and individual securities. Then you go into asset allocation and then individual portfolio management. And then from there, you just keep going kind of up the levels as you'd expect.
Right.
And then was fortunate enough to hook up with Brookstone, where we're just building out a large investment platform, essentially, and where we look across the asset class landscape and try to enhance the opportunity set when we build portfolios.
Yeah, that's excellent. Now, Mark, I know we've also invited you to our Retirement Expo, August 26th. So you're going to be coming to Maryland.
I wouldn't miss it.
I know you're excited about that. And if you come in
I am.
early enough, there might be a crab cake for you.
Count me in.
All right. So I know everybody's here for the webinar and for hearing your outlook on the third quarter. Why don't we go ahead and start, Mark?
Let's do it.
All right.
I'll pull up some slides that I had prepared.
Excellent.
Can you see those, Brian?
Yes, I can. We're good.
Great. So I just want to go over where we're at the end of the second quarter. This has been a very challenging first half of the year, and so much so that it's one of the worst for 6-month periods for investors. And this is both stocks and bonds. So a typical moderate or balanced portfolio that would have 60% stocks, 40% bonds. It's been one of the worst 6-month periods for that. And it's just not stocks, it's also bonds. And as a reminder, when interest rates rise, bond prices drop. So as interest rates rose early part of this year, bond prices declined rather sharply. So you didn't get those defensive benefits that bonds typically or are typically characteristic of bonds during an equity market sell-off. So this has really just been a very challenging environment, whether you're a conservative investor, an aggressive investor, a moderate investor, not a lot of places to go. But I wanted to put that in context because it doesn't stay there. This line kind of shows you, it jumps back and forth from good times to bad times. And we're obviously closer to the low than we are to a market high, expecting a reversal. Markets overall, this is probably the 5th most volatile year. And according to this chart, it is over the last 30 years. This is just showing you the volatility index. This is just gauging how much the market is gyrating from day to day, week to week. And it's almost on par with 2020, which is the pandemic year, of course. And then before that, during, of course, the global financial crisis, but then 2002. So this has definitely been a volatile year. And it may continue to be volatile on a day-to-day, week-to-week basis. And in June, in particular, I call this the ring of fire. That orange there shows you that every industry group in the equity market was actually lower in June. And that's not typical. Of course, you have different businesses, different companies that have a different operating cycle and a profit cycle. But here, everything across the board was hit pretty hard. So that just tells you what type of marketplace that you're in. It's just a more volatile marketplace. That isn't a lasting condition. As you can see, volatility or goes up and down. In this case, we just happen to experience a very challenging June. The reason for that volatility is that the Federal Reserve is raising short-term interest rates, and they're raising interest rates to help slow down inflation. So this is one of the main tools in the Federal Reserve's toolbox, which basically says, well, if the economy is running too hot, creating too much inflation, we'll raise interest rates to slow down inflation and growth. And the reverse happens. They will decrease interest rates if growth is slowing, or if you're in a recessionary environment, to really promote growth and to incentivize more business activity. This chart's interesting. The Federal Reserve, just to clarify, that's the central bank of the United States, and what they are adjusting when I say they raise or lower interest rates, they control the short-term interest rate. It's the Fed funds rate, which is the overnight lending rate for banks. So when banks lend to each other, that's the rate that they impact. And so if they raise that, they sort of disincentivize banks from extending too much credit out there. So it's really trying to pull that back. That's the red line there. And you can see it moves in a stair-step fashion. The green and blue line are the green line is the 12-month forward rate. So what the market expects the Fed funds rate to be. And the blue line is the 2-year Treasury yield. So these move in lockstep. What's interesting here is two things. One, the 12 and 2-year have really overshot. They're really far away from the current Fed funds rate. And then two, if you notice, the 2-year rate is actually below the 12-month rate. And what that is telling you is that market participants expect rates to be rising as they're battling the current inflationary environment. However, after that, they're expected to lower rates. So within this kind of 2-year period, within the next 6 to 12 months, maybe rates are rising, but after that, rates would be declining. So that's where I say a lot of times in markets, you don't have permanent conditions, and keep this in mind that these can change. So maybe in the short term, these rates have overshot to the upside. This is the US Treasury yield curve. So along the x-axis, left to right, that's the time to maturity for Treasury securities. And those are the government bonds with the government issues to pay for stimulus programs and so forth. The gray line there shows the yield as of 2021, or the end of 2021. And the 10-year, if you could look at that, just off center to the left a little bit, the 10-year Treasury rate coming into the year was 1.52%. As of close to the end of the quarter is 3.09%, meaning it jumped about 1.5% or doubled in that time. But it's bumping up against, in the gray shaded there, the 10-year range for where yields have been. So it's well within the range, but it's on the high end. So rates have already moved quite a bit. And that's why you see bond prices decline, as I mentioned earlier. But that's why bonds have been down this front part of the year. However, I think it's really important to note that commodities have almost made a round trip since the start of the year. And so commodity prices really in June declined abruptly and very sharply all the way to the right. You can see it really fell off and fell down. So commodity inflation was running pretty steep to start the year, but that has fully reversed. And prices are almost back to where they were before the Russian invasion, but as I mentioned, right at the start of the year. And one of the objective measures we look at, and you can take away anybody's, any market gurus or talking heads commentary, this looks at the copper gold ratio relative to the 10-year treasury yield. In the blue line, it's the copper gold ratio. So copper is industrial metal, gold financial asset. And what it's telling you is if copper is running hot, yields should be higher because it's suggesting you have a lot of growth and inflation relative to what the price of gold is doing. Well, here, what it's telling us is the copper gold ratio is suggesting that the 10-year treasury yield should be at about 2%. And today the bond yield is in that 3% range in red there. So this is a pretty big gap. And in fact, it reminds me a lot of late 2018, where copper gold did not confirm there was a breakout in growth and inflation, even though the Federal Reserve was raising interest rates very sharply. And just as a quick mention, the fourth quarter of 2018, the market was down about 20% in that quarter because rates were rising. But you can see as we flip the calendar into 2019, well, the bond yield came all the way back down to match that copper gold ratio. So I think this is an important chart to keep in mind. And we continue to monitor this chart and what the readings are telling us. So it's not a time where we think that yields are going to get away from us. In fact, they could move lower, which would mean bond prices would rally and give some optimism for the second half of the year and even into 2023. One of the concerns we had started to highlight in the third quarter last year was that oil prices went past the pre-pandemic levels around that $70, $80 a barrel. But the problem was that oil rigs operating were at about half the level that they were at pre-pandemic. Since that time, oil prices have rallied and rallied up to the $120 level and so forth. Well, they came all the way back down to around $100 a barrel today. And I think part of that reason is because in the last 3 months or so, oil rigs operating are now got back to pre-pandemic levels. So we really had that supply disruption impacting oil. And so now we think that that has somewhat been resolved, and we can see it in today's price of oil, where you're back down to 100 and even at a level that you were at, again, prior to Russia invading Ukraine, which we find interesting. Now, the reason the price at the pump, you may not see a lot of relief at, is because what's happening with the price at the pump is that it's not just the price of oil. The price of oil is the input, but it's what's called the crack spreads are at really wide levels and really high levels. The crack spread is simply the difference between the price of the refined product, gasoline, diesel, relative to the barrel, the raw input barrel of oil. So a lot of that price at the pump is the crack spread really making an influence on that price at the pump, not just the price of barrel oil, because that right now has definitely been under control relative to where it had been. Another area that may see some slowing, and so with commodities coming down, and there's this, clearly the fear of inflation, but commodities have come down. The housing market has definitely been buoyant, to say the least, but a lot of that was predicated also on very low interest rates and in that 3% range. Today, interest rates on a 30-year mortgage are closer to 6%. So all the way back to levels we haven't seen essentially in 15 years, back to the prior to the real global financial crisis and those levels. So those higher interest rates are really putting affordability into question and at least slowing down the housing market, which is one of the Federal Reserve's goal, is to slow down price appreciation or inflation in a lot of different areas. And this is just a quick chart from Redfin that shows you're seeing the most amount of homes decrease their prices that you've seen in a few years. So this is just showing you that it's not everywhere where prices keep going up. In fact, prices are decreasing. To jump into 2022, we usually do a cycle composite. What does the market look like? What does history say the market would look like? Not taking into any particular news or economic environment of the moment. It looks at the 1-year seasonal, 4-year presidential cycle, and then the 10-year cycle. So in blue there, it showed you'd have a weak first half of the year. And in orange there, we tracked that pretty well. We had a pretty weak first half of the year, to say the least, but it does suggest that the second half of the year is a better position for the market. So prices are lower, valuations are lower. So we could have seen a lot of the problems work themselves through the system in the first half of the year, at least as far as the market's concerned. Now, trend is more important than level here. So even though it looks like maybe they're going to new highs, I would just say it's probably best to look at it as better versus worse. And this does suggest the second half to be better than the first, just on this chart. So that gives us reason for optimism. And reason we think that that could hold true is because valuation levels are now below their 25-year average. So this is just the S&P 500 price to earnings ratio. So they're not expensive. In fact, in certain pockets, they're inexpensive. One of the areas that gets talked about a lot is valuations in large cap tech stocks. And so if you take the widely held and known large cap tech stocks like Apple, Amazon, Microsoft, Meta, that's formerly Facebook, and Alphabet, formerly Google, then this chart shows their price to earnings ratio. So it's not their price chart, it's their price to earnings ratio. And what it's telling you is that all 5 of those are trading at PE levels below where they were prior to the pandemic. So prior to any stimulus efforts that came through during the COVID era in 2020. Another area that would give us a reason for optimism is that investor sentiment is near levels where you see maximum pessimism. And that's a contrary indicator, meaning when you see a lot of pessimism, that actually means a lot of risk has been taken out of the market. And there's actually a good opportunity in the market for a reversal and the market to surprise on the upside. In other words, everyone's expecting bad news. And when the bad news isn't as bad as everyone was suspecting, the market can actually glide higher. So this is consistent. This ratio is consistent with other lows we saw in, around March, April of 2020, then December, January of December of 2018. And then in 2015, 2016, we kind of stabilized there for the fall and then into the early spring. And then a couple of others, but those all, it felt bad at the time, but those all turned out to be pretty good points in the market and turning points in the market. So it's not a one day, it's just telling you where you're at in the sentiment cycle. From a technical perspective, the market definitely looks oversold. The S&P 500 is about 16% below its 200-day moving average, which is just a simple trend line of prices when you look at a chart. But you usually track that pretty well. You can go a few percent above, a few percent below, but now we're more than 2 standard deviations below the 200-day moving average. So you can easily see a rally or a bounce of 16% just to get back to that 200-day moving average. And that would be normal. And that's a pretty good bounce. So this is only the 3rd time almost in the last 20 years that it's been at this type of level. And then when we look at the S&P 500 relative to prior tightening cycles, the black line is 2021, 2022, entering that phase. But the other cycles, they all had trouble and worked themselves out for a number of months here and a few quarters until ultimately working itself through the market or the Fed tightening cycle before getting higher. So you can see we're definitely well into this market adjustment and maybe pretty far into it, and at some point some positive news, some turn in events, maybe earnings hold up, and the market will start to respond to that and start to focus on other things going forward other than just the Fed tightening cycle. And so that was the prepared slides that I had, Brian, and I'm going to bounce out of it real quick and stop the screen share if maybe we want to do.
Yeah, it sounds good.
There we
All right,
go.
well, there's a lot of numbers. And so what I'm going to try to ask of you is sort of a summary.
Sure.
Here in July, it looks from your numbers that there's a lot of positivity in trends that you're showing. Now, I personally think we look a lot like the 70s rather than maybe 90s or 2015. I was just wondering about the negativity and what your thoughts are when it comes to maybe comparing to the extreme high inflation of the 70s.
Sure. A couple of different things from the 70s as opposed to today. One, in the 70s, you had a weak dollar. Today, you have a very strong US dollar. And I wouldn't underestimate that strength. The strong US dollar will ultimately exert deflationary forces across the US economy, not in a completely negative way. It's just a way to contain prices, where in the 70s, you didn't have that. And the 70s was unique in the sense that we got off the gold standard. So that's a one-time event. So that was in the early 70s, 1971, and then gold, just kept going and going higher. You also had a wage price spiral. You had two oil crisis type events that came through. So there's a number of factors involved, where today you have a strong US dollar. The labor market, although you've seen wages increase, I think that's coming from a pretty low base. There's been a long, we've been talking about this, or the media's been talking about this. It's been 10 years since wage inflation has really budged and made a move higher. I think that's part of a catch-up phase, as opposed to a new phase where it's just going to break out and go to the upside. So I think the deflationary aspect of the currency, demographics, you also had a different demographic wave in the 70s than you do today. It's a little where you had the baby boomers going through there. Today you have a little bit more balanced with the millennials and the baby boomers and where they're at. So you don't have that. You have technological advancements working their way through, and that continues to be a stabilization on prices. So I think those things are all pretty steady. Now, you could see different variations, but I think those are offsets to the 70s type of style inflation. Sure. And just one last point before I forget about it. The use of oil in today's economy, the intensity of the economy based on oil is much less than it was in the 70s. So in other words, the impact of higher oil prices doesn't have the same impact today that it did in the 70s.
Now, with inflation numbers pretty high, at least based on near zero for the last 20 years, the thing about the oil being about half of the inflation, it's hard to imagine oil not affecting us every day, especially when it feels like it's at the pump. So I guess it's more like the emotional side of the way the markets feel compared to the actual numbers.
Yeah, definitely. And I definitely think there's a lot of credibility to something called the wealth effect. In other words, where at one point it was the price of oil, and nobody likes paying more at the pump, and so that obviously discourages consumers. But the wealth effect is pretty strong, and it shows up from time to time. And that just says, if your investment accounts are growing, your house prices are increasing, you feel better about spending. And the reverse can be true. As those prices either slow down or come down, you feel a little bit less confident about spending. And I think the Federal Reserve has noted this as well. This goes back early in my career, where Alan Greenspan was there, and they talked about the wealth effect into the 90s, and that kept spending going and so forth. So I think that's a big piece of that puzzle. And if you compare the oil and the size of the oil market relative to the size of the housing market is so much larger that, movements there can have an offsetting effect to any of the price of oil slowing consumer spending and things like that.
There's a lot of good information you covered for us. I really appreciate that, Mark DiOrio. We do look forward to having you with our group August 26th at our expo. Make sure you pack your crab shirt so you can wear that, okay?
It's top of my closet.
Yeah. All right. Thank you very much there, Mark.
Great. Thanks, Brian.
I thank all those that have stuck through all of our videos for today. It's a little longer than normal because we had a lot of information. There's a lot going on. Generally, as an advisor, I tell people when we do a proper allocation and we have a portion in stocks and they pull back, we got to examine, are we a buyer in a down market? Do we hold on? Typically, we're not selling in a down market because we allocated the right portion of the stock that we could afford the risk. we do not design our portfolios and our overall allocation for our clients where we need the money that's in the market for this next year. We have emergency funds and other allocations set aside to preserve this money and your wealth over time. That's how we do it here. And that's what sets us apart from other advisors that are out there. We try to cover the markets with Mark DiOrio. Earlier we had Bernie McVey and Alex Monk. We thank you very much for listening. We look forward to working with you and especially seeing you August 26th at our Retirement Expo. That'll run from, you can come after 12 that day. It starts around 1 and it goes to around 6:30. We will be serving food around 5, food and music, and I'll do a little update talk at the end. The big information for Akers Financial Group this year is that our broker-dealer in the month of August will be being acquired by Akers Capital, and Akers Wealth will acquire our Akers Management Company. That would be something that's going to see changes that you will see through the mail with letters and information. So be on the lookout for that. Thank you very much for being a part of Akers Financial Group. I want you to know that we care for you. We thank you very much for being our clients, and we look forward to seeing you in person very soon.